Hi, Steve Sosnick here with today's Interactive Brokers midday market update for Tuesday, December 28th, 2021. The Santa Claus rally, although it seems to be taking maybe what we would consider a slight breather this morning, we're actually only up slightly instead of up sharply today. I guess that constitutes a turnaround Tuesday in this environment. But definitely the year-end rally seems to be in effect. Let's go into some of the things that foster a year-end rally. Last week we talked about it in one of our pieces, and we basically said that it seemed like an inevitability after a year like this. There are typically year-end factors that are very favorable to the stocks that have been working out. And in this case, the stocks that have been working out are the biggest stocks in the index. I'm actually overstating it. The outperformance of the cap-weighted index is actually not so much greater than the outperformance of the equal-weighted indexes. But certainly over the last few weeks, the market has been driven by the performance in the biggest cap stocks, the Apples, Amazons, Googles, et cetera, the big mega cap stocks that make up, as we know, as you've heard ad infinitum, 25% or so of S&P and about 50% of NDX. So those are the stocks that have been working. What we typically see in a period like this are investors, institutional investors who like to show performance, who like to show the illusion that they've been holding these stocks all year long, adding to those positions at the end of the year. We also tend to see, I'm going to call it some gamesmanship in some smaller stocks they may own. This goes back to my really old days as an over-the-counter market maker, and I would know that certain accounts would give you buy orders and really ask you to kind of, buy them sloppy, so to speak, into the end of the year. The only reason why you would ever buy something sloppy is actually if you want the price to go up. So you do the math there. So I don't know the extent that still goes on, but the human nature behind it hasn't changed. So we could fill that in. What's very interesting this year, besides the fact that the Santa rally, I guess, started early, because typically that's supposed to be this week, the week between Christmas and New Year's. And remember, this year it's a little bit longer than normal because we have a full week this week. There is no day off for New Year's. There usually is. Only if New Year's falls on a Saturday does the market stay open the entire week. The logic for that is because, as I mentioned, all kinds of end of the year stuff goes on, position squaring, tax loss selling, blah, 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 blah. They don't want to close the market a day early because people would get upset by missing that if they were, if they were procrastinators, and there always are. And so they don't close early for it. And I guess the logic of closing for New Year's Day when it's on the January 3rd doesn't make a ton of sense either. So here we are. So it's a longer week. It means you get one more day of listening to financial media talk about how stocks are higher on light volume, et cetera, et cetera, et cetera. One thing that's very interesting also this year is we've started to talk about divergences, and we are seeing more new lows coming out. This was a story that this is something we've been talking about for a while, about how new lows relative to new highs had been increasing. I don't remember the exact day I put it out, but we started talking about it a few weeks ago. But it's actually new lows hit a new high yesterday. I know that sounds strange to hear. And when that happens in the last week of the year in a rising market, it doesn't happen very often. The last time it happened apparently was December 1999, according to a Bloomberg story today. So take with that what you will. We've alluded to the various late 90s type of characteristics before. So I don't want to overstate it because it's not like there's one incident. This is the second time it's happened. The first time was kind of catastrophic in hindsight, but that's hardly what I would call statistically significant. One other thing that I found very interesting today was I started to look at the Fed balance sheet. I realized I hadn't really checked in on it in a while. And I noticed that it was going up more or less at the same pace it had been going up all year. Now, you wouldn't expect to see that if the Fed's tapering, would you? That would make, you'd expect it to continued. The point of the taper is that they'd been buying 120 billion in treasuries in combination of mortgage securities each month, and that it was going to taper 15 billion a month to 105, then to 90, and then at the last meeting they said we're going to increase the taper even faster, which would imply 90, 60, 30, 0. But I looked at so you'd expect to see the Fed balance sheet increasing, but at a decreasing rate. But yet it appeared to be increasing at a linear rate. That was a bit odd. So I went and looked at the numbers. You can find these numbers on the internet. That's called the H4.1 report. It's out there for all to see. And in November, the Fed holdings of treasuries and mortgage-backed securities rose by about 105. It was about 104 billion. Let's call it 105 for argument's sake. That's exactly what you would have expected given the taper. In December so far, from December 2nd through December 23rd's report, which would go through the week of the 22nd, those holdings increased by 129 billion. That implies to me that the taper isn't really tapering. The only explanation for that could be that they're expecting a big runoff of securities at the end of the year when holdings mature. I don't know that that's the case. It would have to imply a fairly large runoff of holdings, i.e. about 40 billion worth to get down to that taper target. So that really bears watching, and that might actually be one of the things that's adding a little bit of fuel to the rally here, is that the Fed is actually not doing what they've told us they would do. So I want to watch that report very carefully over the next 2 weeks. Probably won't show much this week. Probably will show more a bit in the first week of January, because we can actually see if the holdings decline because of year-end maturation or not. So I'll close this one with a joke, since this is the last video that I intend to do this year. And that's with the old joke, of course. What's the difference between a bond and a bond trader? And that is that the bond eventually matures. And on that sad note, I will see you all again next year. Take care. Bye-bye.